Welcome to the Interest Rate Academy. Class is now in session. The yield curve is a graphical representation of the relationship between the interest rates, or yields, and the time to maturity of debt securities. It provides a snapshot of the interest rates for a range of maturities, typically ranging from short-term to long-term. The yield curve is a crucial tool in finance and economics, offering insights into market expectations, economic conditions, and monetary policy. The yield of a bond or other fixed-income security is the annual return on investment, expressed as a percentage of the bond's current market price. Maturity refers to the time remaining until a bond or other debt security reaches its contractual end date, at which point the principal is repaid to the bondholder. In a normal or upward-sloping yield curve, short-term interest rates are lower than long-term rates. This is a typical scenario where investors expect a higher return for locking in their money for a more extended period. It often reflects a growing economy. An inverted or downward-sloping yield curve occurs when short-term interest rates are higher than long-term rates. This inversion is often seen as a potential indicator of an economic downturn, as it may suggest that investors expect interest rates to fall in the future. Some of the factors that can influence the shape of the yield curve are interest rate expectations, inflation expectations, and the current level of economic growth. Policymakers and market participants closely monitor the yield curve for insights into economic conditions and expectations. Central banks, such as the Federal Reserve, use the yield curve information to assist in making monetary policy decisions. Investors use the yield curve to make decisions about asset allocation and investment strategies. We have now completed our introduction to the basic principles of the yield curve, an important concept in economics and finance. We've examined how interest rates and maturities shape the yield curve as well as the ramifications for investors, decision-makers, and the overall economy. Thanks for joining us today. Remember, the more you learn about interest rates and other financial markets, the better you'll be at navigating the complex world of money and investing. Until next time, don't forget to hit that like button and subscribe to stay updated with the latest in finance. Feel free to share with anyone you feel would find this video informative. The Interest Rate Academy is produced by Chuck Borgioli, a 30-year veteran of the credit and interest rate markets.